All right, welcome back to the channel. Today we're going to be checking out DR Horton, ticker symbol DHI, and getting into the 5-year chart here, we can see it's been on a nice tear over the last 5 years, especially even recently. It's probably up about 100% from recent lows in 2022, and we're 200% to almost 300% since the COVID lows. So this one has been ripping price action wise over the last 5 years. All right, here we have their Q3 2022 investor presentation. So DR Horton is a home builder. So this was actually a subscriber request. So we're going to check it out, see what we can find. And yeah, not exactly my expertise. Now they do give some financial information here, but we'll go over that in the spreadsheet. And this is kind of interesting. It goes over their growth, consolidation, and market share. And it looks like they actually had a big drop in closings from 2006 compared to 2011. But the percentage basis of the overall market, they've been slowly gaining market share basically since their inception in 1992. So they start off really small and creep their way up to about 5, 6, 7, 8%, and then now they're right around 13% of the market. The top 5 markets of this home builder are DFW, Houston, Phoenix, Austin, and Atlanta. So pretty heavy exposure to Texas, it looks like. And yeah, and here we can kind of see the breakdown of their product offering by price. Homes from 0 to 300K, 21%, 301 to 350K, 25%, 350 to 400, 20%. So a large chunk of their homes are in that $300,000 to $400,000 range. Yeah, 66%. Wow, if I could read, if Jesse could read. Then we got 21% from 400 to 500, and 13% of homes are 500 up. So they are targeting probably that, I don't know, it probably depends on where you are, more affordable. 400K or 300K can be a lot in some places. In my area, that is crazy cheap, but land costs a ridiculous amount here. So I wonder if this is just home value or if it's also land value. And then we get a nice breakdown of their leverage ratios along with their return on equity over the last couple of years. I mean, that's only like 2 or 3 years. So 22, 31, 35, 34 in 2022. So yeah, pretty decent recently. Return on inventory. This is ROI, home builders return on inventory. I saw this and I was like, return on investment? What? But nope. Return on inventory of 24.6% in 2020, 37.9% in 2021. 2022 was 42.8%. So I'm guessing 2022 was probably really strong for them with the crazy amount of housing demand, or 2021, 2022. With a pullback maybe in the last 12 months or so. The housing market's been insane lately, but one thing is for sure, we are short on housing in general across the country. So I think home builders in general are going to have a pretty good runway for growth, over the next 10 years or so. All right, and here we have a breakdown of book value per share and diluted EPS. So EPS growing pretty nicely over the last several years. It's been pretty good. The only thing that worries me with this is like there's got to be some cyclicality at play here, and I don't know enough of this market to be like, okay, when's that cyclicality gonna hit? Because that could hurt. That could hurt whenever it does. Then here we have, let's see, 5-year capital allocation. Cash flow from home building operations, $8.6 billion over the last 5 years. Shareholder return through dividends and share repurchases is $4.9 billion. So, and we will see that they have a small dividend, but they have a nice, they've been repurchasing a decent amount of shares lately. So we'll see that in the spreadsheet as well. Investments in rental operations is $1.5 billion, acquisitions $0.8 billion, and home building debts, reduction in liquidity increase $1.4 billion. So pretty good capital allocation over the last 5 years. But my biggest thing is just like, I don't know, like, is this a moment in time, a 5-year period in time where they just crushed it? Or is it going to continue? Yeah, that's what I'm a little hesitant on. We can see here in 2023 so far, they've repurchased about 7.7 million shares for $764 million. And they still have about $657 million in remaining share repurchase authorization for the year, or I think just in general. And they expect to get about $1.1 billion of repurchases done in fiscal 2023. So that would be another 400 million or so, 350, 400 million of share repurchases through the end of 2023. Here we get a little bit of insights into their rental operations. In Q3 of 2023, they've had about 589 million in revenue, homes sold about 1,700, inventory about just under 2 billion, homes under construction 1,300 completed homes, 6,270, total lots 3,650, finished lots 1,440. So yeah, this is pretty interesting when we look at the rental side of their business. And then they also have multifamily rentals. Revenue is about 77 million, 230 million units sold. So I'm wondering if they're probably doing a mix of selling these rental specific units as well as leasing them out. Inventory for multifamily is about 1.3 billion units under construction, 6,920. So a lot of multifamily under construction right now. Way more than single family. Interesting. So completed units 1,880. Homes under construction for the single family side is about 1,300, and under construction for the multifamily rentals is 6,920. So they are building a lot of multifamily rentals. And then it also looks like they own about 63% of Forestar, which specializes in I believe acquiring and selling lots to builders. So that's pretty interesting. They're kind of got their hands in a little bit of everything: home building, single family, home building, rental, home building, lots acquisition. Which I think, you package all that together well enough, and you probably have a decent edge potentially on competition. So. Going to their expectations, we can see in Q4 2023, actually just go over 2023. So 2023 as a whole, they're expecting consolidated revenues in the range of 34.7 billion to 35.1 billion. Homes closed between 82.8 to 83.3 thousand. Rental home units closed between 6.5 to 7,000 homes/units, which that's interesting. I wonder if the multifamily is per door, counted as a door. Like if they have a fourplex, is that a 4-unit, right? That'd be something interesting to find out. Income tax 24%, cash provided by operations greater than 3 billion, and share repurchases of 1.1 billion. We have homes closed in 2023 Q3 is about just over 20, and home sales revenue just over 8 billion. It looks like this is where we're going to probably get into more of the financial data, which we can look at later. Gross incomes, we can see the ebb and flow over the last couple of years, ranging really from 21% to 23%, or 21% to 30% on the high. Now this is interesting, their inventory. So homes in inventory, it looks like right now their inventory is going down a bit, which I would say could be good. Sold inventory is at about 19,000, and specs out are probably another 25,000 for a total of 43,800 right now. So they're not down another 2020 inventory levels, but they have been coming down on their inventory lately. Then we have their land and lot pipeline, pretty massive. So 25% owned, 75% controlled. Right now they're sitting about 555,000. And I'm guessing that would be lots ready to build on, I would assume. Then I would say that depending on the market and the markets in different geographical areas, they would probably target certain areas to develop more than others to get the best return on investment. Looking at their geographical diversification, they're in 113 markets, 33 states. You can see the Northwest is Colorado, Oregon, Utah, and Washington. Southwest is Arizona, California, Hawaii, Nevada, New Mexico. South Central is Arkansas, Oklahoma, and Texas. Southeast, we got Alabama, Florida, Louisiana, Mississippi. East, we got Georgia, North Carolina, South Carolina, Tennessee. And North, we got, pretty much geez, everywhere. Delaware, Illinois, Indiana, Iowa, Kentucky, Maryland, Minnesota, Nebraska, New Jersey, Ohio, Pennsylvania, Virginia, and West Virginia. Whew. All right, so that's their big breakdown. And last but certainly not least, we got their public debt maturities by year. So it looks like we got, $400 million in 23, no debt maturities in 24. We have a nice amount in 25, 26, and 27, and 28, about 500 million, 600 million, and 500 million. And those guys are sitting at some juicy interest rates, 2.5%, 2.6%, 1.3%, 1.4%. So as long as they can control that debt and either get it paid off or, get it rolled into lowish interest rates, not too bad. So the 23 debt maturity is at 5.75% right now, or it is at 5.75%. I would expect if they had to roll these over in current interest rate environments, it'd probably be between 5.5 to 6.75, something like that. Something to keep an eye on. If they can't get these paid back by their maturity dates, they might have to roll that debt into higher yielding or higher interest rate debt. Now let's go over to the historical financials. All right, so here we got the income statement. We can see the growth over the last 10 years. Been pretty dang steady with a nice pullback here in 2023, kind of when housing dropped off. And we'll see if it picks back up, but interest rates going up probably didn't help at all. You see the EPS diluted growth, earnings per share growth over the last 10 years has been really solid. You can see kind of when they started buybacks, probably in 2018 or so, and we started getting a downtrend in weighted average shares outstanding diluted. You can see the increase in SG&A and operating expenses over the last 10 years as they have grown. Going over the balance sheet, we can see their cash position looks like it's about $3.3 billion right now. They have about $6 billion in total debts, it looks like. So not too bad, honestly, not too bad. Free cash flow has kind of been all over the place. Operating cash flow has been kind of just whack here and there. It looks pretty cyclical. I'm guessing, I'm wondering if their cash flow is like looking really bad because they're reinvesting so much into the business, into growth. So it takes a lot of capital away from their cash flow as they do that reinvestment. That's what I would expect. But yeah, I would have to get a better understanding of why that cash flow is so bad, but that's kind of what I'm betting right now. We can see that from their cash flow, they put a lot towards debt repayment, which makes sense. They've been deleveraging, it looks like, a lot. And they also have been doing a lot of common stock repurchases. For the ratios, you can see they've had pretty good margin growth over time, margin expansion. Operating margins have expanded and bottom line margins have expanded, pulling back briefly over, 2022 to 2023 and starting to recover a little bit here. Dividend payouts, dividend growth has been good. Their payout ratio is abysmal at 7% of a dividend payout ratio. So very, very low payout ratio, which should be healthy. Which I like. For something like this, I actually kind of do agree that buybacks and opportunistic buybacks when they're really flush and business is going good and their valuation is low kind of makes sense, because you can't really do it. If you have a lot of cyclicality, you probably can't really do a really steady dividend, because then you're in jeopardy of cutting that dividend if you're doing like a 50% payout ratio on your dividend or something like that. So looks pretty good. See, and this is this is the weird part. Per share metrics. You see the massive increase in net income per share, that growth, but it hasn't really transferred to operating cash flow or free cash flow per share. And it's probably just how the business operates, especially with reinvesting so much of that capital back into expansion and growth. But I don't know, I'm going to have to dig more into that. All right, now let's get into the valuation. We can see that historically over the last 10 years or so, their yield metrics, especially like kind of net yield and EBIT yield, have been pretty dang high. So probably an average of 7 to 10% on the net yield. EBIT yield has been, 10%, 12%. Free cash flow, like I said, I'm not sure. Maybe this is one where you need to just ignore the free cash flow metrics, depending on, I don't know, like digging into it more, if that's not a fair reflection of their true cash flow, then that might be something you need to go off of the net income or the EBIT yield instead of the free cash flow. I really need to figure that out though. You can see their revenue growth over the last 5 years has been about 18.9%. Their, let's see, EBIT growth over the last 5 years is around 36%. Their net growth over the last 5 years has been 41%. Their free cash flow growth over the last 5 years has been about 9%. And so if we ignore free cash flow, then yeah, they've been growing bottom lines like ridiculous. Revenue growth is about 18.9%, but I don't know, like we could get some margin compression if we go through a pullback in the housing market. Interest rates stay high, people aren't buying as much. On the other hand, we're really low on inventory, so I don't know if that's even gonna matter long term. We might get some type of cyclical pullback, but let's go ahead and pop in some numbers here. And we can also see that over the last 5 years or so, they've bought back about 1.3% of shares on average per year. Over the last couple of years, it's been more closer to like 3% of their shares outstanding. So they have been buying back a decent amount. All right, so for our target rate, we have 17.5% with a 0.81% dividend, margin safety 5%, and base KGAR of 12.5%. We are normalizing over the last 3 years. Then we're doing a net income only. Yeah, this one is interesting. So dilution for the very bearish case, we have 1.73 in buybacks to very bullish 3.3% in buybacks. Bottom line growth in the bearish scenario or very bearish would be 15.6 and to the bullish 23.75. EBIT yield spread, or actually this is just going to be average yield spread for net income because we're doing a net income evaluation, would be 12.05% yield. Multiple in the very bearish case to 8.9% in the very bullish case. And with these growth metrics, we would basically get to about 9.96 billion in net income at the end of the 5-year period for the base scenario. Now, this is this is interesting because I don't feel confident in this valuation at all because I don't know the industry that well. So I feel like there's a lot of nuance that I'm missing with this, and I just do not know this industry well enough to be confident in this at all. It is interesting, just from the numbers, it's interesting. We don't have any 5-year targets from management or 5-year guidance by management. So I tried to dig that up. I couldn't really find anything. I couldn't really find any normalized target growth rate that they were targeting. We're in a pretty cyclical industry that can have major headwinds if, economic stuff goes awry. So I don't know. I think there's a lot of kind of risk baked into this. And on top of that, I need to make sure that I am looking at the right cash flow or the right bottom line metrics. And that net income is really the best one to use out of these. And, because if it's free cash flow, then we're hosed. But I'm pretty sure the free cash flow is so messed up because of the massive amount of CapEx going into growth. So yeah, pretty interesting. From these numbers, we have a very bearish buy price of $98, bearish buy price of $116, a base case of $139, bullish case buy price of $167, a very bullish buy price of $203. Fair value for it right now, current fair value would be about $116 in the very bearish, $126 in the bearish, $136 in the base case, $147 in the bullish, $158 in the very bullish. 1-year targets would be about 117 to 173. Our 5-year targets would be 225 in the very bearish, 266 in the bearish, 318 in the base case, 383 in the bullish case, 466 in the very bullish case. And that would give us a rate of return across these scenarios between 12.82% KGAR and 30.43% per KGAR. But I am not confident in this at all. So yeah, this was a request from the Discord and I'm doing it, but man, I will tell you, I do not know this industry that well, and I'm not gonna try to pretend that I do. This does get me interested though, to probably learn more about it, because, what am I missing? Do I have a good grasp of the risks and the accounting for this type of business? What are their competitors? Because it does intrigue me. It looks pretty good. I just don't have the confidence of me knowing this industry well enough. So I think this is going to be one that I am going to continue to dig into. And yeah, hope you guys enjoyed this, and we'll catch you later. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube.